and welcome to this Astranti YouTube video on the reasons for acquisitions. And if you do like this video, then please like and subscribe at the bottom of the screen and visit the website www.astranti.com for more information and more samples. And this is one of many different videos that we are going to be releasing, some relating to the case study, some relating to topics, some relating to general exam technique. And in this particular video, we're going to be focusing on the reasons why companies might acquire other companies, and keep a lookout for a future video where I'm going to be looking at the problems that can arise during acquisitions. So let's quickly run through some of the reasons why companies would acquire others. And this is a very important topic, particularly for your F3 studies, but also for your case study exams, as the topic of mergers and acquisitions often can arise in the management and strategic case studies. So, some of the reasons why companies might acquire others. One is to increase the revenue or increase the market share. If you purchase a major competitor to you and absorb them into your own organization, you're suddenly opening yourself up to a much larger market share. And it might also improve your power as well. If you are at the mercy of suppliers and then you purchase a major competitor and suddenly you are the big company that those suppliers want to supply to, you are increasing your power in the marketplace. Also, it can lead to economies of scale where you remove the duplication of operations. So the example here I've got is of a power tools company. If a power tools company has its own accounting department and it has its own human resources department, and the other power tools company also has its own human resources department, its own accounting department, if you purchase that company, merge it together, you can then have the same human resources department, the same accounting department doing the operations for both companies. So you're actually reducing the amount of costs across this new larger organization by integrating the human resource and accounting department. You might also do it for market development, to access new markets overseas. And the example I've got here is of a Chinese media company that purchased an American media company, so it then had access to the American market. It could also be to purchase products or brands. So if there's a particular product that you really want to sell and you think you can integrate that into your own operations, you might purchase a smaller company in order to do that. And Hewlett-Packard's done that before, where they have purchased other technology companies to then bring in the products into the Hewlett-Packard organization. Some other reasons why companies might acquire companies could be for on-selling as well, where you can then sell your products to the company that you've purchased existing customers, and then you can sell the company you've purchased products to your existing customers. So you actually benefit both organizations, or the products of both organizations. You increase the customer base of them. Another one is asset stripping. So this is where you purchase a company, perhaps a company that is undervalued and it's not particularly profitable at the moment, but it's got a lot of assets. So you purchase the company, then you strip it of all its assets, as the name would suggest, and sell off all these different assets at a profit. And Hanson Trust was a company that would often do this. They were expanded in the 70s and 80s by purchasing lots of small companies that were in debt and then selling off all the valuable assets. You might also acquire to gain control over the supply chain. So for example, I've got an orange juice manufacturer here. This orange juice manufacturer, they might purchase their oranges from an orange grower, and they might also sell their orange juice. They sell it to the consumer in bottles, but they also sell it in bulk to companies that produce goods from orange juice, such as orange ice lollies or orange chocolate, etc. So if they purchase an orange grower and they also purchase a company that makes goods out of oranges, then they are controlling the supply chain much more effectively. Another reason could be through diversification, to reduce the risk by not relying on a solo market so much. And this is similar to the access new markets here. And the example I've got here is of a Chinese construction company that purchased an American construction company. Now, it reduces the risk to this organization by having a construction company in both the US and in China. Because if something happens to the Chinese construction market, that company would collapse. But now that it also has an in, so to speak, in the American construction market, it is diversified. If something happens to the Chinese market and it goes stale for a few years, they can rely on the American market and vice versa. Final few main reasons for it. One is for tax relief, and you may think, well, tax relief, that sounds a bit dubious. We shouldn't be trying to get around tax, but it's perfectly legal. If you are a very profitable organization, you can purchase an organization that is loss-making so that you actually get that company into your group of companies and you can use its assets, etc. But the losses are then added to your profits, and it makes your group look like it hasn't made any profit. And then you don't have to pay any tax because you pay tax on your profits. It could also be to acquire staff. If there is a small company in your marketplace, but they've got some really, really skilled staff that have a lot of good ideas and you want to bring those staff to your organization, you might acquire that smaller company to bring those staff to your company. And big companies, big tech companies have often used this as a way of bringing staff into the organization. And finally, for big data opportunities, big data, very important in the CIMA syllabus, and acquiring organizations can bring a lot of data. Remember, data and information is so important in the modern business environment. And an example of this is when Facebook purchased WhatsApp. They purchased WhatsApp for $19 billion. That sounds like a lot of money, but they were able to access the details of hundreds of millions of users by purchasing that. So they considered it to be a price worth paying because they suddenly had access to hundreds of millions of more users that they could then on-sell Facebook to, and they could integrate WhatsApp into Facebook and create a lot more operational synergy across the two organizations. So those are some of the key reasons why companies acquire other organizations. Now, of course, this is very much just an overview of the reasons why it happens. It doesn't actually go into any detail about the actual process of acquiring organizations, but these are the reasons why companies would want to do it. It's important that you have a very good reason for acquiring another company, because if you do it for the wrong reasons, it can cause all sorts of trouble and you can end up wasting billions and billions on these acquisitions and it not actually benefiting the organization at all. And we will come on to that in the second part of this video, which will be due in a few weeks, so keep an eye out for that. But thank you very much for watching this video. Hope you have enjoyed it and found it useful. Hope you now have a good idea for why organizations would want to acquire other organizations. And if you did like it, please like and subscribe at the bottom of the screen, or visit the Astranti website, www.astranti.com, for more information and more free samples, more sample videos. And we've also got some sample study texts and some sample question packs. It's all really useful for your exam.